We're very much bottom-up stock pickers. We, of course, don't ignore macro trends, but we do tend to be company-focused. And within that, also try and make sure that we've got appropriate allocations into the various sectors which we think will add the best return for our shareholders. Remembering, of course, we are always diversified across the Canadian economy, and in fact, typically more diversified than the benchmark is, because we are bottom up and have a high active share and don't need to adhere closely to the benchmark. It really comes down to the bottom-up stock selection methodology and focusing on the correct sectors that will enhance returns. So, for example, we've managed to understand where the trends were going, and we've been underweight energy for probably about 7 years, and around that same time we repositioned the portfolio and we've been significantly overweight technology, and many of those companies have really helped to drive the growth. And so that, together with, of course, we employ gearing in the portfolio, which so long as we can get a return that's higher than the cost of the leverage, ends up meaning that we've got enhanced returns to our shareholders. And then finally, it really does come down to picking the right stocks. And if you look at our top 10, you can see a number of stocks that have either grown to that position very quickly. Shopify is an example of that. That was a company that we've only bought fairly recently, and it's in the #1 holding now. Or a company, for example, MasterCard, which is not a Canadian company, but we do have a small selection of US companies, and that was something we bought in 2013 and has grown to that position. And that is how we do manage the portfolio. We don't make big bets on any companies. We have a reasonably concentrated portfolio, but all new positions that enter the portfolio enter at 1 or 1.5% and then grow into the top 10. CGI's dividend policy has been changing over the last 5 years or so. Before then, we used to pay quarterly dividends exclusively out of the income generated in the portfolio, and then pay year-end special capital gains dividends, because Canadian General qualifies as an investment corporation for Canadian tax purposes, which, put simply, makes the fund tax-free on a flow-through basis, so long as we flow through the income and the gains in the portfolio to our shareholders. However, in 2013, we decided that this wasn't transparent enough for the market, and even for our shareholders, they were left wondering what their year-end special dividend was going to be. So instead, we put out a press release saying that going forward, we're going to provide steady to rising dividends on an absolute dollar basis, and increasingly emphasize and eventually eliminate the year-end special. So from 2013 through 2018, the total distributions remain static at 76 cents, but we raised the quarterly dividends every year. 2018 was the first year that we never paid a year-end special, and 2019 now we've raised the quarterly dividends again, keeping with the 5-year trend of raising quarterly dividends. So the total distributions have risen as well, and so we're paying a distribution of 80 cents for the year. And then the intention of the board is to provide steady to rising dividends as we, on a sustainable basis, as we grow the fund. Well, you have to remember that Canada is an open trading nation, and so we require global trade to be strong. We have free trade agreements in place with roughly 2/3 of the global economy, and in negotiations with some other locations as well. And these include the European Trade Agreement, what became of the TPP, and of course the big one is the North America Free Trade Agreement. The negotiators between the United States, Canada, and Mexico have come to an agreement, and the new an agreement between the three countries is to be called the USMCA. However, that has not been ratified yet, and it's not clear that it will be, just due mostly to electoral timing and an ongoing dispute between the three countries about US tariffs on steel and aluminum. That said, we've been able to tap into the booming US economy, as well as maintaining and strengthening and growing our ties with the rest of the world. So the Canadian economy has been very steady. Remember, we've never really had much of a financial crisis a decade ago that the rest of the world did. There were no housing crash and there were no bank failures. And because of that, the Canadian economy has managed to remain strong despite the downturn in the Canadian oil sector. And the move away from the commodities bull cycle we saw a decade ago, really what it's meant is the Canadian economy has rebalanced, and Canadian General has managed to move with those trends. No, I don't. You have to remember the Canadian banking sector is, first of all, there's only a handful of the big banks. They are protected by the legislation governing the Bank Act in Canada, so it's very difficult for a foreign bank to come in and become a Schedule A bank. And then on top of that, they're also well run and well capitalized. We saw that in the financial crisis. They were one of the best capitalized banks in the world. On top of that, a lot of the impetus for saying that the bank should be shorted is the skepticism regarding the Canadian housing market. In the financial crisis, Canada, as I mentioned earlier, had no housing crash, and so there was some sentiment that we were due. And now, with the house prices being on a tear in Vancouver and Toronto, there's a sense that perhaps they're overvalued. However, there's very little evidence of any sort of overbuilding in the economy, and the Canadian mortgage market is very different from in the United States, for example, in that there's no non-recourse lending, there are no money down mortgages, anything less than 20% down has to be insured, and the CMHC won't insure anything over $1 million. So overall, it's been it's actually quite a robust market. And if you look back even to the early 1990s, which was our worst housing crash, mortgage arrears only ever hit somewhere below 0.7 of 1%. Very different from the very high levels we saw in other markets during the housing crash. We've also seen that in Vancouver and Toronto, which are the only markets that show any sort of elevated pricing, the prices seem to have moderated while the number of transactions fell off, but seem to have recovered a little bit as well. So while it's a concern, the level of household indebtedness and housing affordability in Canada, it doesn't look like there's a reason to worry about the financials being caught up in any sort of downdraft with the housing market. Well, I think the biggest recent development in the Canadian energy sector is that the Americans have their own energy sector now with the fracking you see down in the Permian and elsewhere. And what that's meant is that there's been a glut of oil in the North American market, that there's a lack of interest amongst U.S. investors to invest in the Canadian oil patch since they have one of their own. And at the same time, some of the investments in increasing production that we saw a decade and more ago, particularly in the Canadian oil sands, have come on, and they're scheduled to keep on going because these are massive investments. These don't change overnight. And so you've actually had an increase in production in Canada at the same time that our pipeline capacity has not grown, or not grown nearly significantly enough. And so there's a big problem of egress in Canada. Plans to build new pipelines have been very caught up in political maneuvers, both legislative between various provincial governments and the federal government in Canada, and also special interest in environmental groups. So what it's meant is that the Canadian companies have been forced to rely on their own cash flow to generate their production and any expansions that they're doing, and that really there's a glut of Canadian oil that can't get to market, and this is one of the biggest political and economic concerns in the Canadian market at the moment.